Right, hello everyone. I'm just going to give a few moments to everyone to get settled. Well, hello and welcome to the State of Fintech Mortgage Lending panel hosted by the Canadian Lenders Association. We have a great group of panelists joining us today and a wonderful moderator, Hartley Lefton from McCarthy. Hartley is going to take us through a panel discussion, and then we will be accepting questions live. So remember, you can submit your questions at any time and we will get to them at the end of the discussion. And as always, this panel is being recorded and will be emailed out to you all afterwards. So without any further ado, I'll hand it over to you, Hartley, to get the discussion started.
Well, thanks, Danielle, and thank you all for joining us today. I'm really excited for our conversation and for your questions. As Danielle mentioned, my name is Hartley Lefton. I'm a partner with the McCarthy Tétrault law firm based in Toronto. In my legal practice, I work closely with regulated financial institutions and distributors of regulated financial products, including a lot of fintech companies. I'm looking very forward to our conversation today and to learning what our speakers are seeing in the market. First, I'll ask you all to introduce yourselves and your businesses, including where in the country you carry on business. Arif, do you want to take off?
Sure. Arif Mulji with the Amur Financial Group. We are a private lender based out of British Columbia. We lend in BC, Alberta, Ontario, Quebec, Manitoba, and at this time, nothing east of Quebec.
Thanks. Joseph?
Hey everybody, I'm Joseph Fooks from Mortgage Automator, one of the co-founders here. We're actually based out of Toronto. We built a loan origination and loan servicing platform to help with the automation of the private lending space in today's day and age. We started off with Canada, but we've now progressed into the US and even have a few customers in Australia as well, but essentially focusing on the North American landscape at the moment.
Thanks. Kevin?
Hi, I'm Kevin Fettig. I'm president of CMI Financial Group. We are exclusively a residential private mortgage lender and servicer that operates nationally. The only areas we don't operate in are Saskatchewan and the territories.
Thank you. And Mike? Sorry.
I'm drinking a cup of coffee. That's okay. So hi there, everybody. My name is Mike Saniga. I'm the co-founder and vice president of operations of Connect Markets. We're a peer-to-peer marketplace that gives brokers and lenders the opportunity to connect and fund deals, mortgage deals, easier, faster, and cheaper than many of the alternatives out there. Right now, we have brokers and lenders from coast to coast using Connect on a regular basis to either have their deal funded in the case of brokers or to find new deal flow in the case of lenders.
Great, thanks a lot. Great to meet you all and look forward to our conversation. And to start us off, a question that's on the mind of many Canadians. We all hear stories about, and sometimes experience firsthand, the unprecedented demand for residential real estate, helped in part by continued low interest rates, government stimulus, immigration to Canada, and other factors. It seemed for a while that by about the 10th day of every month, we all heard stories in the media about how the market the month prior got hotter and hotter. Though anecdotally, it seems to me to be cooling down a little. Arif, Kevin, maybe can you kick us off and tell us what you're seeing? Is this hype? Is it real? What should we be looking for?
Yeah, I'll go ahead first, Kevin, if that's okay. Definitely over the last 12 or so months, 11 or 12 months, the hype was out there and we were seeing it in the results month over month. Property price appreciation, the volume of transactions in the real estate markets were going up and up. A lot of it tied to the reductions in the interest rates going back to last March. We saw a lot of consumers, and the data is out there that the banks' originations went through the roof. People trying to take advantage of hot real estate markets and refinancing opportunities to capitalize on those lower interest rates. We've now seen where we're at today. Definitely, there is a cooling. We're seeing that. Inventory is growing in most major markets, and the sales transaction volume is going down. By virtue of what may be called buyer fatigue or offer fatigue, consumers were just tired of making multiple offers and losing on bids on properties, and it got to the point where realtors were promoting specific tactics for their buyers to try to get ahead of some of these multiple offer opportunities. Increasing the size of their starting bid, putting in different parameters to the bids to try to win those. We're seeing less and less multiple bid opportunities. We're seeing the sales price to list price ratio come down a bit, closer to 100 and even under 100 in some markets. And probably the most telling stat is in days on market, where you are seeing the days on market expand out. We saw situations where the days on market in major markets in property values in excess of $1 million were less than a week. And we are seeing that extend out. So we're definitely seeing some more stability in the market at this point, probably from May over the last couple of months. We've definitely seen that trend.
Thanks. Kevin?
Yeah, I'd echo the same observations. I mean, certainly in the million plus market, certainly was a market where we saw, for a while their days on market were significantly lower. I think they're starting to revert back close, still not where they were historically, but widened out quite a bit. I mean, what's also interesting on the market trends has been where we're seeing price increases. So, I mean, it's all, for a long time, this has been sort of a tale of two cities of Toronto and Vancouver seeing rapid house price appreciation for most of the last 10 years. But in the last year, we're seeing a lot of that house price appreciation occurring outside of those major centers. So, we saw 30% increases in cities like Barrie or Windsor, or, areas outside of, the GVA and GTA proper. So, it certainly has been, I think, part of it is also people moved out of, we saw people moving out of the major centers and looking for larger space as part of COVID. Same time, we saw condo prices actually soften a bit. And more recently, though, I think the market's starting to come back on the condo side, and it's been, relatively hot market in the condo sectors where things are starting to improve. I can't speak specifically about Vancouver. I haven't really looked at it that closely. Certainly, the GTA, we're starting to see condos probably being, one of the hotter markets, especially for larger size condos. The other thing that's interesting is sort of through this has been Calgary and Edmonton, which, experienced a fair amount of, weaker house prices because of oil and gas. Over the last year, they were up probably 5.5%, 6%. They're still not back to where their peak market was, but they certainly have improved quite a bit.
All right, thanks. So what I'm hearing is that the market is likely to continue to be at least stable-ish. And so I guess my next question is, Mike, Joseph, can you put my mind at ease? Why is the Canadian residential real estate market not like the US market in 2006, 2007, 2008 or so?
Well, I guess I'll just start. I think the first thing to talk about is the housing availability. I think that based on what I'm reading, based on what I'm hearing, there's still not enough housing to accommodate for all the people that are coming into the country, specifically in the two larger urban city centers, or again, the GVA and the GTA. I also feel specifically in Canada, why I don't think we're going to have an 07, 08 situation happen again is because of the stringent bank qualification guidelines. They're tougher than ever before. AM qualifications are, max 25 on insured loans. Posted rates, you're qualifying based on 5% today, even though money's available at sub 2%. Variables and self-employed, like they're really buckling down on what income you can provide to qualify. And so from that perspective, if you're going from and applying for a mortgage with a bank, you really have to have the income to show that you can service these loans. And I read statistically, default rates are very, very low, even post-COVID, like even after the government stopped providing certain incentives, or the banks have, stopped the mortgage deferrals, people are paying their loans, even in the private space as well. So that's why I feel we'll be hopefully avoiding, or looks like we'll be avoiding that 07, 08 situation.
Yeah, I agree, Joe. I think we're seeing the same thing. I think generally speaking, culturally, Canadians are more conservative, both from a homeowner's perspective and a lending perspective. We're seeing on our platform a lot of deals come through, and despite the uncertainty in the marketplace, lenders aren't picking up just anything willy-nilly, right? If the deals don't make sense, they're not getting picked up and funded. So that's great. I think that gives me a lot of added confidence in the marketplace that, a lot of some of the ills in the States were sort of brought on by lending institutions. And I think we've done an admirable job north of the border to keep things stable.
It's certainly reassuring. Joe, you mentioned COVID. If I think back about a year and a half to March 2020 or so, COVID really started to affect Canada. The consensus at the time seemed to be that real estate sales valuations would really slow down, that no one would take $1 million mortgage, no one could conduct an open house in the middle of a global pandemic with the expected complete economic collapse. This obviously proved to be incorrect, as there were ways around parts of the COVID disruption, including some tech solutions. So on top of that, from your comments earlier, it seems that Canada's residential real estate market may still have some room to run. So I guess going back to you, Mike and Joseph, I'd appreciate any thoughts you have on what some of the pain points are in lending, how technology improves that. Apart from increasing deal flow, what can technology do to improve the process for lenders, for intermediaries, for consumers, and of course, buyers and sellers?
You want to start?
And Mike, if you want to kick off.
Okay, sure. Yeah, to my earlier point, lenders aren't going crazy to take any deal in front of them. But what we are seeing is that brokers are looking into alternative and private lending as another option for homeowners who just can't get the funding that they were originally able to get, or certainly at a necessity from a liquidity perspective, a refinancing perspective. And from our perspective, technology has helped the industry. From our perspective, we help simplify the process. So we've had brokers, big regional brokers come to us saying that they didn't really know where to start when they get into private lending and alternative lending. And they've kind of said, well, I'm just not sure. It seems like a lot of risk. So we're just going to punt it over to somebody else. But now that they have this ability to get their deal seen by every lender on the platform and get multiple offers and see the transparency in the process, be able to provide their clients with alternatives, it certainly has added confidence. And we're seeing brokers come on all the time that were kind of initially afraid of this. So we're trying to calm them a little bit, and the technology certainly helped. I'm sure, Joe, you're seeing the same thing.
Yeah, and further to Mike's point, I would say, obviously nobody wanted COVID to happen. It's been a kind of a disaster for certain industries. I could say the lending industry, the finance industry has not been as affected by it. I could say the private space is quite healthy, and in fact, healthier than ever. We've seen a growth in people essentially acquiring our platform to utilize on a regular basis. What I've seen is that people were used to going to the office, and everything had to be done in an office setting. And I think what technology has done is allowed companies to operate as efficiently, potentially even more efficiently, just because employees don't have that travel time now. I know for a fact certain employees will commute an hour each way. That's 2 extra hours they can put into their day-to-day routine or slightly finish earlier. Therefore, they're happier. They can get more work done. More processes have been now put into place so that companies can run more efficiently. And from a technology perspective, as a provider, I feel we've done a great job providing ways for people to work in a collaborative environment and still get the same job done, but in a more efficient manner, quicker. I think it's actually progressed our space significantly by creating integrations, collaborations with our other partners in the industry, and sort of pushing where we are versus in the US. Because I can tell you, being in the US, they're definitely further ahead in a lot of ways from a technology perspective. They're really pushing the envelope. And I'm kind of happy to see that we in Canada are starting to do the same. So I would say for COVID specifically, technology has taken a huge step in the right direction. Sadly, it was this that pushed it that way, but I definitely see a big progress from March 2020 till today.
Thanks, Arif, Kevin. Mike mentioned private lending, and of course, you both are in the private lending space. From your perspective, how do technology solutions, how is technology affecting what is that you do, what your customers are seeing, both on the lending side and the borrowing side?
Kevin, I'll let you go first this time, and I'll jump in after.
So we've always had the benefit of having our own technology platform and have invested quite heavily on that side as well. We've always been a virtual business. So, I mean, COVID was anything not a major impact to our operations. I mean, there's some things we did differently on the technology side of, is more of document signing, those kind of things that allowed us to operate in a purely virtual aspect. But we certainly have always focused on technology as part of our business, and it's critical to gain scale. The challenge, I think, on the private side has been you're talking about a story loan, and depending which range you're in terms of that private space, if you're talking about a near prime, you can set up more underwriting rules. If it's more of a second or a third, it's a little tougher. You're more concerned about what the exit strategy is. But there's always ways that you can use that technology in terms of how you get the deal from the broker, how your underwriters are able to process the information, how they're able to take, look at anything in terms of credit data. We're certainly working on tools such as document automation, as well as using tools like to be able to gain access to customers' bank account directly, be able to use some degree of and automated analysis of the bank accounts, as well as looking, we're always on the lookout for tools that make it easier for the underwriter to do their job. And it really is, it's the underwriter still has to make a decision, but there's things that are really manual processes that don't add value. And where you can take that out of the loop and make it automated is always a benefit and a value. And that's what we're always looking for.
Thanks.
Yeah, I think Kevin, I think we definitely share the perspective of trying to be a virtual organization even before the onset of the pandemic. What the onset of the pandemic did for us is it made us proactively look at more technology enablement within our organization. And for us, there's two sides of it. Like Kevin's group, a lot of their business comes through the broker channel. So we have a broker channel business like CMI, but we also have a direct-to-consumer channel, which has been our larger channel for many, many years. And what we found that we lent more towards from a technology perspective was how do we get better customer acquisition, and how do we enhance our customer retention strategies. So we implemented a lot of technology that allowed us to get in front of consumers quicker, provide them with a decision quicker, and put their mind at ease. One of the differences with the direct-to-consumer space is oftentimes the consumer comes to the lender with a need, and we're trying to pair up the best financial solution for them. And so putting their mind at ease up front became very important. What we found from our research was that consumers that contacted us, if they didn't get a decision or feel like they had a solution that was suitable for them, they had to start looking and continue to look for another solution. And so we tried to speed up that process and bring it more front and center for the consumer, to show them that we did have multiple financial solutions for them that could fit their needs at the time. And we found that to have a very favorable outcome for us. We're continuing to invest in technology to drive more efficiency in the organization. Like Kevin said, there are elements of private lending where you can't automate the entire process because there's some elements of the decision and underwriting that require a set of eyes. But as much as we can, we're looking at platforms like Mortgage Automator and others to help us drive more efficiency throughout the organization as we continue to grow.
Thanks. So keeping in mind, I guess, that the private lender industry and I guess mix as well. Obviously, the most common and best known part of the market is the big five, big six banks who underwrite most of the loans in Canada, including CMHC coverage and CMHC-like coverage. I'm wondering, Arif, Kevin, again, if you can share with us your thoughts about where private lenders, where mix fit within the lender blend in Canada. So we've got this assumption that I think it's a general assumption that the big five, big six will be your primary lender or your first choice. But where does we've got this great private market, this great MIC market that has a role. In your view, where do you fit in, and where do you think this part of the market should go? And Arif, if you want to kick this one off, Kevin got the last one.
Sure. I think there's always going to be a gap between where the banks lend and consumers' needs lie. And whatever the reason is that the consumer can't go to the big five or big six banks, that's where private lenders and MICs will fall into place. For a variety of reasons. People have life events, things happen, people get divorced, there's job losses, there's short-term financial needs for kids' school, for retiring parents, whatever it might be. So that's definitely a place where private lenders fit in, where the banks don't. There's also consumers who have other needs. They're self-employed, they're new to Canada, they can't satisfy the requirements of the banks, and that's another spot where private lenders fit in. We've seen a ton of liquidity. Lenders across the board have a lot of money, and that's driving down rates. So we are seeing in the private space, we're trying to be competitive at lower rates than we would have been historically. And that's just a part of where the gap has moved. So as the gap moves down the continuum, we kind of follow it down. That's kind of where I think we'll always fit, is filling the gap where the banks stop.
Yeah, and just to echo on that comment is that, I mean, it's sort of where that boundary is sort of changes over time. So you talked about, the banks and where the insurers were. Is that if you go back to sort of, 2005, in that time, sort of 2005, there was a high degree of competition between the mortgage insurers and trying to gain market share. So you saw a bunch of new products being introduced. You saw them moving out in terms of the kind of credit they were willing to do. I mean, you had some mortgage insurers offering mortgage insurance on second loans. I mean, most people don't think of mortgage insurance seconds, but it did exist, and it actually performed quite well for the insurers. You saw insurance on HELOCs. You saw, essentially zero, very limited premiums for people doing lots of investment properties. Once B20 kicked in, though, we've seen basically a retrenchment of government support for that activity back to sort of pre this, aggressive expansion by the insurer. So they basically have just rolled back 15 years of expansion in terms of federal policy. And it's really expanded the private space. And so, what was in large cases, even 5 years ago, a person would have been getting an insured loan, that they no longer qualify. And so the private space has expanded because of that. And also, I think just because of where rates are in general, plus the level of, the size of mortgages, we see, a lot more private activity occurring in major urban centers where house prices are well over $1 million, and they don't qualify for mortgage insurance. So you start seeing, those situations that, Arif talked about, where someone is business for self, they, have good income, but they don't necessarily have stated income that will qualify. And so those rules create, significant opportunities for the private lenders to lend to what are good customers. And so I think the boundaries will always move back and forth, but there certainly always will be a role for private lenders.
Thanks, Kevin. You mentioned interest rates. I remember 2004, I think it was, I spoke with a friend who was buying his first condominium. At the time, we had a very serious conversation about fixed rate versus variable rate, given how low fixed rates were. And the thinking was then that rates had nowhere to go other than up. I looked it up recently. At the time, fixed rates were about 6.3%. So it turns out the rates could go down further, and my friend was very wise for ignoring my advice about interest rates. I see we have a question from the audience, a question about technology. And so, Joseph, Michael, I'll ask you to share your thoughts on this. The question is about technology, and I'll quote, "Technology drives efficiency. However, do you feel that technology has made the consumer the center of the process? In the post-COVID world, will the mortgage ecosystem revolve around the customer journey?" I appreciate any thoughts you have on that.
Yeah, I would say it's definitely becoming more consumer-centric. I think it's before the mortgage broker would come to your house, he'd sit there for an hour, taking down your information on a napkin, on an application. He'd bring it to his office. He'd then, now, you've got very comprehensive online forms. They make it very easy for borrowers to apply, to get an understanding as to what they're going to qualify for. They're able to upload documents, their IDs. Things can be processed much quicker, getting their credit processed. There's a lot of automation that comes with it. And then from there, these other systems can then push directly into systems like ours or potentially Connect, where now lenders are easily able to review this information, specifically for privates, and come back with approvals much quicker. I'd say the approval process in general is becoming quicker. Like, I know I've dealt with a bank when I got my mortgage. It takes like 3 weeks just to hear back from somebody. And luckily I wasn't in a rush, so it was fine. But I know that if I dealt with a mortgage broker who had connections to, let's say, 30 or 40 different institutions with all these rate promos, it would have been approved within 24, 48 hours. And I think that's really making everything around the borrower now, the experience, like how it comes in. If the information is not fully pushed in, they're getting notifications to maybe follow up with that person. But the whole in-person meeting is basically done. I don't even know anybody who's meeting their mortgage broker in person today. So from that perspective alone, your time of travel, efficiency, if you can't help them, it's, I can't help you, I'm sorry, or you've got to go private, or you've got to go to a second tier institution. It's no more of, wasting people's time. And there's just so much competition today. People are definitely fighting for the business. So it's all about the borrower today, I would say.
Mike, do you have thoughts about customer centricity in technology?
Yeah, I'd echo what Joseph has been talking about there. I think generally speaking, the customer journey should be the center of the mortgage ecosystem, because it's their needs that both sides are trying to fill. So the challenge for brokers, lenders, tech companies alike, I think, is how you best provide that service and fill those needs for customers and homeowners or commercial lenders or borrowers, to get them through that process. I think there's still that level of uncertainty and I think generally speaking, the level of financial literacy varies across the board. There's always going to be people who need that human touch, those human touch points. Where technology can certainly help is take out all of the non-value add activities, non-value add in the eyes of the consumer, right? If you can get my application automated, and if you can get me to sign things automated and whatnot, I'm happy to sit down and have a coffee with you to talk about my goals, my objectives, what do I need, those types of things.
Thanks. And just a reminder to all attendees, if you have any questions, please feel free to insert them in the Q&A at the bottom of your Zoom link. Mike and Joseph, on the topic of fraud, risk, and diligence, can you help us understand how technology helps market participants? We were speaking earlier about the continued growth of the residential real estate market. Kevin and Arif and their businesses have their own growth goals. Technology can remove some pain points, as we discussed. But how do we ensure that the system remains credible, reliable, and that consumers do not bear the cost of fraud? It's a little different than the last question about customer centricity. This is, I guess, incidental customer centricity, making sure that customers are not adversely affected by something that they don't expect to happen, but when it happens, can be very bad.
So yeah. I would say, something actually Kevin touched on, there are companies out there that can validate your bank account information. They can validate IDs. I know there's a product called Blue Ink that one of our partners uses, our legal partners uses, because they're doing remote signings, where they can scan the ID front and back. You do a selfie with your phone. It runs a facial recognition scan of the individual, then runs that information through all the ministries to see if there's any warrants for their arrest, for fraud, for any other issues. Obviously, with credit, Equifax is doing what they can from an additional due diligence perspective to validate people's information, to mention if there's a fraud on the person's file. Obviously, and today, you also have lenders being able to have access to title much quicker. So I would say with technology, you're able to do significantly more due diligence on a borrower before you get all the way down that file or all the way down that line, have it in the lawyer's office, incur a bunch of costs, potentially go through with that transaction. Where if you do 3-4 steps ahead of time, 5 minutes, maybe a few dollars of your own resources, you could save hundreds, thousands, potentially millions of dollars, avoiding fraud just by doing a little bit of homework. And that technology is available at our disposal today.
Yeah, I totally agree. All of that technology is out there. I think we're all pretty aware that if no matter how good your security system is, if somebody wants to get into your house, they're going to find a way. And I think technology really helps to support the manual processes going on, to help support and verify the work that the underwriters are doing already. And if there's ways to do this automatically without touch points, I think we're also seeing that the more people that touch data, personally identifiable information, the bigger the risk for data breach, and certainly something that we are aware of. So really what we're looking at is making sure that we continue to collaborate with like-minded tech companies like yourselves and help out this process, help support this process from birth to grave.
I just add on the technology side and fraud it's a bit of a ongoing challenge in that it's also the fraudsters who use the technology as well. So I mean, more recently, I think is more in the insurable space. There is a fairly large fraud ring going on in the Toronto and to some extent the auto area where they were able to produce very good employment documentation, false bank account statements. When you call to confirm employment, there was a call center that was set up that would respond that said, yes, this is the person, this is their employment verification. They had websites set up that looked quite good for each of the companies. So it was a very, they used technology to create a virtual business around fraud.
Right.
And so, that's always the challenge we have to be aware of on the lending side is as much as we're using technology to try to mitigate fraud, fraudsters are using technology to make, what fraudulent presentations look more real.
Thanks. And of course, the one piece I'll add is the use of title insurance. That title insurance will often help you appreciate it's after a loss or after there's a challenge, but at least something standing behind the transaction and hopefully supporting you after there's a problem. For our next question, we'll go to the attendees, and we have a few questions that I guess thematically are about disruption and technology, and so I'll try to consolidate them. I remember back when Fintech would have been fax machines and email, and now Fintech is something much more advanced, AI, machine learning, and in some cases crystal balling. If you all could please talk about data, open banking, AI, how it's advancing the sector, and also in a very highly regulated sector like finance and mortgages and lending, do you think that we'll see the same disruption that we've seen in retail, let's say with Amazon, transportation with Uber, and other verticals that have really upended the value chain and I'd say differently intermediated an industry where before you wouldn't have the same kind of intermediary, and now you're going through an Uber, an Amazon in order to access the thing that you're acquiring. I know there's a lot there, which is good and bad. Maybe I saw Mike, you were smiling first, so I'll ask you if you want to kick it off.
All right. Yeah, I think there will be disruption in the marketplace. I think you think about artificial intelligence. I started a company back in 2010 that automated the interpretation of consumer insights and demographic data. And what we found, and we utilize similar technology here, what you find is that if you put 5 analysts in front of the same documents, you often got 5 different answers. So by being able to use technology to sort of standardize the approach and the decision criteria by which you underwrite and make decisions, there's certainly an ability to or an opportunity to sort of make better decisions. Notwithstanding what Kevin was saying before about, kidder's going to kid, right? But certainly it will make it more streamlined and give the industry more opportunity to work on the client service side, the client experience side, if you can take all of the other stuff away.
And that goes back to your comment earlier about customer centricity and where the customer is in the value chain.
I have a few comments on this, to be honest. And I think machine learning is a very loosely used word in the industry today. I think you have to be very cautious when you unleash these types of technologies. And I'm going to say specifically in the private space, because banks work within very closely regulated guidelines. It's very black and white, especially on an insured product. I think private mortgages really work in that gray area from the ability to truly understand what goes on behind the deal. Because I'll give you an example. You'll get a deal and at face value, it's 95%. So our system can, like we've already been experimenting with auto underwriting technology, machine learning data, analyzing data, predicting whether these borrowers are going to default on loans. We've been experimenting with that technology, but here's where I'm going to put caution on that. You get a deal at 95% loan to value. Face value, it's an auto decline by the system. But when the underwriter picks up the phone and says, does your mother and father have a property they're willing to put up as collateral as a temporary subsidy until you get things reorganized? The answer sometimes can be yes, which means that deal went from 95% to 60%. And where CMI and Amur would write that deal, if a system was auto underwriting, it would be an auto decline with an auto decline email to the borrower saying, try again later, or it's not for us. And I think that would actually be bad for business. And I think that as much as technology is very important in today's space and today's day and age, there still needs to be a manual intervention at some point with humans to review this information, review the data. Someone will submit a deal, say the property is worth X. Based on that, it could have been auto approval. But where's that value coming from? From the borrower, from the realtor, the broker who wants to make the deal happen, or an appraisal? And so you start doing due diligence and realize, well, all the comps are actually selling for 2.5 mil, not 3 mil. The deal is no longer 65%. It's now 90%. It's an auto decline. So again, if you auto approved a deal, now you've started the motion of getting a deal moving forward. You've now issued a term sheet with your name on it. There potentially might be liabilities with that. You've now potentially ruining broker relationships because they'll say, well, you approved the deal. Why are you now declining the deal? And now higher senior management has to get on the phone and explain to the broker why the deal was approved, because there was an auto adjudication piece that their system did for them. So you really need to tread very carefully. And I still think that from the security perspective, doing due diligence on borrowers, having access to purview, credit, these ID verification systems, I'm all for it to make that underwriting process quicker and giving you a better decision-making tool. But I think from actually looking at the loans, there are people with experience for a reason who still have a purpose at these companies to make sure that the loans that these companies are writing, especially in the private space, especially because these are predominantly equity-based deals, right? That's because the bank already said no due to certain income verification reasons. Private lenders are stepping in from an equity perspective to do these loans at obviously slightly higher rates. So they need to make sure their security is really protected because statistically there could be a higher default rate. And therefore you need human intervention to review it. So I will kind of push against the tech from that side of things. I've been presented with opportunities to review these types of technologies. And I always come back with, well, what happens in these situations? And they don't have an answer for me because they haven't thought of that because they're not in the space. And that's kind of how I feel about it.
If I'm hearing you correctly then, Joseph, what you're saying, I think, is technology is a tool. It's not the answer.
100%.
It's
not like the Airbnb space. I don't think, and I think with the fiduciary bodies governing Ontario, BC, all these provinces, it's gotten harder to get approved as a broker, as an administrator. There's more due diligence, there's more reporting than ever before. There's more compliance than ever before. I think going to these open markets, I think it's going to be the opposite. They're becoming more and more heavily regulated than ever before. If you go back 10 years, the private lending space was the Wild West, even in Canada. So I would say, I think it's the opposite. It's not going to a free market. I think it's going to be very heavily government controlled, government centric, because it's no longer a little blip. It's no longer an underground casino. It's now a $15 billion industry in the mortgage space. It's become part of the mortgage space. And I think it needs to be regulated for the consumer's protection as well, to be honest.
Arif, from the blender, the broker perspective, what do you think about this?
Yeah, Joseph, it's interesting, you as having a company that is all about utilizing technology and enabling the process, to say that, hey, there's always going to be a human touch. I think that's one of the things that we firmly believe. For people who have recently completed a mortgage transaction or refinance, this is not an easy process. Even for people in the industry who know mortgages, who know the ins and outs, it is not an easy process at all. And I think we hear a lot about fully digital mortgage, fully automated mortgage. And Joseph, I'd have to agree with you. I think there is absolutely a place for the value add of a human touch. Like I said, we operate in the direct to consumer space where we're dealing with people who have a need. They want to hear about solutions. They want to hear about what's possible for them. And oftentimes they don't have the knowledge of the mortgage space to understand what truly is out there for them. We also recently launched what we're calling a digital brand. It's a digital brokerage brand. But our value proposition is that it's human assisted or advisor assisted. So the pieces that can be automated, like the ID verification tools, the appraisal tools, the bank scraping, all the things that you talked about, Joseph, great. I think it brings forward a lot of the pieces for the consumer that they can get a lot done from the comfort of their home through a device or through their laptop. But then it brings it to a point where there is a need for a dialogue. There is a need for a better understanding. Even the recent survey from CMHC or MPC talked about the value that brokers bring to the transaction. And I think customer satisfaction ratings are in the high 80s, if not low 90s, in terms of what value does the broker bring or does the partner bring. And it's the knowledge, the advice, perception around what's possible. And those are all things that I think will continue to be important for the consumer moving forward.
Thanks, Arif. I'm reminded about trends in sports right now in the last few years. In the 80s and 90s, the idea of Moneyball, which was a book and then turned into a movie with Brad Pitt, won some Oscars. And the idea was that math and numbers would drive a lot of good solutions and help produce a lot of championships. And I think there's a move back from pure analytics to combining analytics with what some can call the eye test, or Joseph, to your point, using analytics as a tool rather than using analytics as the answer. I mean, if analytics were the answer, then frankly, and I'll say this as a Toronto resident, the Toronto Maple Leafs would have had a much better postseason than they did last year. Analytics are important, but analytics are not the only factor to consider.
Sorry, I was going to just say one thing. Here's what I can say about analytics. From a data consumption perspective, sure, the system can spit out, reporting on values of real estate in a certain geographic location. And you can run reports on, well, if I lent on all these deals, how come all these deals are going bad in this specific location? Is it, what's the demographic? What's the issue? Have prices gone down? I agree. Technology and data should be used from that perspective to provide you this information so you can make better educated decisions on where to lend or whatnot. But I think going back to it, I still strong. And again, going back to what Arif was saying, you wanted to generate documents. I agree. Someone to spend 20 minutes generating a manual document makes no sense. Where our system can come in and generate that same 6-page document perfectly formatted with no spelling errors in 3 seconds, totally worth it. Updating brokers, borrowers, lawyers in real time with auto-generated emails and text messages, 100%. I'm all for it. That's why we're building this type of technology. But to get a deal to a finish line, like there's like 8 stages in the process. You got to look at the deal, do due diligence, talk to the broker, sell the borrower, get the appraisal to come in, get the lawyer to do their work, make sure there's no issues. If there are issues, who's going to deal with these issues? Whether it's liens, whether it's numbers are not as accurate as we are, shortfalls of $5,000 while already pushing a threshold. So many things you need humans to do. That's kind of how that's where I fall back on.
I think just one thing to add, if I could, is in the private lending space, in the mixed space, we have a responsibility to our shareholders. So at the end of the day, we have that duty to our shareholders in managing. We're risk managers, and so for us to go back and say we utilized a tool or a series of tools that gave us an output, and based on the output we drove a decision, we can't shrug our shoulders and say, sorry, we're seeing some yield compression because we made some poor decisions. So I know might be belaboring the point a little bit on this topic, but behind it all, if I'm waving the flag for the private lenders in the mixed space, that is our responsibility, is to the shareholder. And so we have to manage how we lend appropriately. And that's why for us, I think there's both sides, as from the risk management perspective as a lender, and for the service element for the consumer and their customer journey, that the human touch, the human element, I believe will always be a part of this process.
I just think there's a continuum of how much you can automate. If you sort of go from where the bank space is to, where you've got sort of the mid-sized banks like Home, to the private space, each of those has a degree to which you can automate and do things. You get into the A space, it's a lot easier to generate a pre-approval because, as Joseph has talked about, it's basically you have a set of rules that the insurer has. You know how that's going to work. So you can generate an approval fairly easily. As you start moving out to the private space, these people have already been declined. So you really need to understand the story. And that's where the value of the underwriter comes in. And that's where it's going to be, understanding their story, understanding what solutions you can provide, and also understanding what their exit should be. Because the other thing about a private lender is we're not doing a 5-year loan with, that we want to renew in 5 years. Arguably, we're trying to deal with the customer that, it's a 1 or 2 year loan, and then they're progressing towards a B lender. If they're staying with private lenders on an ongoing basis, it probably means the risk profile is not what we thought they were, and they're likely going to default at some point. It's a different business space that has to be managed. And technology is great for some of the things we do, but we've looked at trying to use AI, and as Joseph has said, you can't use those tools in a way that allows you to generate most of your decisions. You may be able to get the tails right in terms of the distribution of the easy approvals, or the slant, the declines that just you're never going to do. But most of the core business just doesn't fit in that kind of technology.
Thanks. That was a good conversation. And a reminder to our attendees, if you have any questions, please put them in the Q&A. Earlier on, I think, Kevin, you mentioned OSFI guideline B20. And of course, we've heard a lot about the mortgage stress test, especially in the last couple of years. Kevin, Arif, if you can maybe help us navigate what problems you think the regulators are solving, what are the implications of those solutions, and especially how that affects the private market. So what's happening in the private market driven by some of the changes and initiatives that I think are really targeted at the big 5, big 6 banks?
I mean, B20 was, and the whole stress test was, I think, introduced around the concern that lenders and borrowers could be potentially entering into mortgage transactions where they could be taking more risks than they thought they would be. So the stress test was designed to say, okay, you're borrowing at 2%. Well, what if rates happen to be 5 years from now, 4 or 5%? Are you going to be able to refinance that mortgage? So it was trying to prevent that kind of risk. And underlying that was also some work the Bank of Canada was doing where, which I think was driving a lot of the concerns that OSFI had, is the bank publishes this report and they look at the number of new loans where the borrower has a mortgage debt to income ratio over 450%. So right at the time when the stress test was introduced, I think the aggregate number there was between sort of high ratio and sort of insurable loans of somewhere around 17%. And then through the time of the implementation of the stress test, we saw that drop to below, 12%. It's now somewhere around 20%. So the stress test really hasn't accomplished what they wanted it to do in terms of mitigating what they see as those concerns. Moreover, it's really restricted the ability for a first-time home buyer to go out and borrow. So you're starting to see, people come up with creative ways to manage that. So it's become the bank of mom and dad now helps you provide your down payment so that, when you look at your overall debt ratios, they're going to be in line. You're seeing some things in terms of, where people do the loan then or arrange a second to get the financing in some way, if they can, to finance it. Or you're seeing structures such as co-ownership. Now, co-ownership isn't that common, but it's another way of doing it where families will go and say, okay, well, we're going in and buying the property together and I'll take the first floor and you take the second. So you've seen all those kind of solutions around the stress, because of the stress test. But ultimately, it's sort of like I still struggle with, looking at the current levels of what I think is 5.25%. When will we see 5.25% again in terms of a mortgage rate for the stress test, and in terms of where the banks are lending at? I mean, the banks I think would be quite happy with 5.25%, as long if they had the right margins, because ultimately that's what they're worried about, is the margin is not the absolute level. But it's hard to imagine when the Bank of Canada is sitting there saying their natural rate of interest rates is around 2, maybe 2.25%, that somehow we're seeing that 5.25% is the rate we should be worried about borrowers borrowing at. And it really just comes down to we're in such a low rate environment that the Bank of Canada doesn't have a policy to control this. So you can target inflation with interest rates. Now you have low interest rates. What else are you going to do? So they set this rule up, but it hasn't been very effective.
I guess just to add on that, I know Kevin and I have been kind of in sync on a number of things, and maybe just a bit of a difference of opinion on this one. I think hardly a couple of things that we talked about were you mentioned earlier about the U.S. and why are we not like the U.S. And then we also talked about where do private lenders fit in the whole continuum of lending. So I think this is the stress test was by virtue of, hey, what happened in the U.S. and adjustable rate mortgages where people were set up for failure. They were allowed to borrow 100% of the value, if not more in some instances. Adjustable rate mortgages where first 2 years you had a teaser rate and then it went up and people couldn't afford those payments. Maybe in the fact that this is Canada and we're conservative and we say sorry more often than we need to. It's part of that conservative approach to lending is how do we make sure the system doesn't flop like we saw in the U.S. And as much as I agree with Kevin that a stress test rate of 5 point something is probably too high. I think the objective behind it is managing risk for the whole system, and that's what it's after. As a private lender, again, like we said before, we move where the market tells us to go. So as the stress test changes, the rate or the requirements go higher, it moves us up the continuum, and as they move down, it moves us down the continuum. We'll always have a space for sitting outside of where the banks and some of the monoline lenders sit, and we go along with that. I think it's a good bit of co-opetition in terms of where we sit, where other lenders sit, and where the big five sit.
No, and maybe I didn't express my point well enough. I broadly, from a macroprudential point of view, I agree that you needed to have some control, but I think the design of the tool wasn't well put together. I mean, initially it was based upon looking at posted rates, but posted rates are designed to be, compute penalties for mortgage rates. When you pay out your mortgage, they're not really a true level of a rate. And so, the whole way of structuring the stress test has not, I think, been reflective of what should be, a fair sort of test for qualification is where I'm getting at. Not that it is not beneficial to our industry because of that, but it certainly is. I think from a broader consumer perspective, it does exclude a lot of first-time home buyers from getting into the market.
Thanks. I remember some years ago speaking with a commercial banker from one of the big banks who said to me, and I'll paraphrase, any idiot can lend money. The art is actually getting it back. And Arif, to your comment about conservatism in banking, I think that maybe summarizes it a little crudely, but as well as anything else. We're almost out of time. There's one last question from the attendees that I wanted to put out there. Maybe Joseph, if you can address it. The question's about transfers and settlements. And with SWIFT increasing its speed, perhaps based on alternative pressure from platforms like RippleNet, what do you think the future looks like in the transfer settlement space?
Great question, Hartley. I would say, so there's definitely a pressure on moving away from your typical banking, digital banking processing. Obviously, a lot of the large lenders will use EFT to process payments, pull, send money. What we're hearing, what we're seeing is, you submit a pull, you've got to do it 2 days before for the accounts to settle. Then you're not getting a report 3 to 4 days till after the first of the month, hypothetically. And if there's a weekend involved, you're not finding out till the 5th or the 6th that those payments are bouncing, which is creating less time for you to reach out to the borrower, collect those payments so they can be ready for the next month's payment. And so what we've been doing in our space is we've been working with a partner where I'll mention their name because they're part of the CLA, Zoom Payment Rails. We have a full integration with them where we're bypassing the banks altogether. We've built a direct connection through Zoom where you can pull payments directly through our system. They settle significantly quicker, and the time for pull is essentially same day. And the response time tends to be between 24 and 48 hours. So we're already significantly increasing the time that people know about payment settling. With that technology, we're actually able to create autoresponders to notify teams internally. Because right now, today, for example, you go to your bank, you submit your payment, you have to log into your bank to receive the report of what payments bounced for that particular day. Whereas with Zoom, they notify digitally right through our system. So it creates triggers to essentially send emails to the appropriate staff within the company, auto mark those files as NSF, which could technically trigger auto communications to borrowers by sending them text messages and emails in real time before a human can even pick up the phone to call that borrower to let them know the payment has bounced. Same thing with pulling and sending. It's just significantly quicker. So I would say we're already in that space. We're one of the first companies in the mortgage space to have this integration. We already have clients using this technology in beta. We'll be making announcements shortly about the full usage of it on our system. But that technology does exist today. They've done a phenomenal job with it. They've made it very easy for clients to sign up, to register. For example, another issue quickly, if you're not a large lender like a CMI or Alpine, the bank might not even give you permission to pull payments right away. You have to have credit approved, whereas Zoom will work with smaller customers to get their businesses off the ground. So huge benefits. And yeah, that technology does exist today. I wouldn't say it's crypto fast, but this is where the space is going, and we're all over it. And that's something I 100% believe in automating, pushing that envelope on the digital payment side.
All right, great. Thank you, Joseph. Arif, Kevin, Mike, it's 4:29, And so I think we've done a pretty good job of gobbling up the hour. I want to thank you all for your thoughts. It was a great conversation. I enjoyed it. I learned a lot. And Danielle, I'll put it over to you.
Yeah, right on time. I just want to quickly thank you all for your incredible insight, and to you, Hartley, for moderating a great discussion. Thank you everyone who joined us today and submitted great questions. We invite anyone and everyone to become a member of the CLA and participate in the FinTech lending community. And of course, to attend upcoming events, you can find them at lendersevents.com. But with that, thank you all for joining us today and have a great rest of your day.
Everyone, take care.
Bye, everyone.